Good morning. This is Tom Aspray with the Viper Report, 6:30 a.m. Eastern Time on Wednesday, August 31st. I wanted to bring you up to date. Hope some of you saw my weekend article in Forbes, new verdict for the stock market. In that, as well as the attached recording, which I did for subscribers on Saturday morning, showed that the AD lines had likely topped out and that negative numbers on Monday would put them into the corrective mode, and that has occurred. Of course, the market's been under pretty strong pressure all week. Here's a look at the SPY. We've dropped below the daily Stark band here the past couple of days and below the weekly S1. We're getting right into the 50% retracement level of the entire rally. Okay, if you look at the AD line, had a nice strong close on Thursday, rapidly reversed, and as I mentioned with Friday's close, which is right on here, that we were likely to drop below these lows, and that put the AD line in a downtrend. So on a daily basis, we're in a corrective mode. Of course, how low will we go? The strength of this rally and the fact that we broke through this major resistance line B on the rally suggests that we're in the bottoming process. This is not the start of a new decline below the June lows. So right now, typically, we've had some 90% down days. You'd look for a move back up into the 20-day EMA, which is in the 411, 412 area. Of course, the QQQs look even more negative, and they failed to move back above their moving average on that rally last Wednesday and Thursday, and now have plunged below the uptrend, confirming a new downtrend here. So this could need some work before it can turn back to positive based on the daily studies. So clearly lower highs, lower lows, downtrend. So support for the AD line back in this area, and you can see the 61.8% resistance, or support rather, is at 294.18. We've already dropped below the 50%, and we've hit the weekly S2 pivot so far in just a couple of days of trading. It is a busy week for economic data. You can see yesterday's numbers. Consumer confidence came in at 103.2, well above expected. Job openings also higher, and that put pressure on the stock market even further, as it suggests the Fed's job to quell inflation will be even more difficult. And of course, we get the jobs report on Friday. Lots of other economic data between now and the ISM manufacturing, etc. So no reason yet to unfasten your seatbelts. I hope you enjoyed the following video. It shows you in more detail some of the technical evidence I was looking at over the weekend that didn't bode well for stock prices. Thank you very much. Good morning. This is Tom Aspray with the Viper Alert Market Wrap Update for the week ending August 26th. Let's look at the markets. I'm sure most of you are already aware of what an ugly session it was on Friday, but let's look at some data that supports that view. Major averages, you can see we're all crushed. Dow down 3, NASDAQ almost 4, S&P 3.4. VIX was up 17%, but still quite low at 25. And of course, the futures were smacked. Market internals were decidedly negative. 428 up, 2751 down. Up to down volume also was in the 90% of volume on the sell side. So in a bit, we'll discuss the implications of yesterday's move and what it may mean for the next several weeks. Okay, so let's first look at the futures. We came into the week short from around 42.90. That we hit all three targets. 42.01. We got down here in the 41.18, I think, level, and reversed to the long side on Wednesday. And we're able to make it. We were long from I guess 41.37, 41.38. Sold out half. 41.87, another part at 42.12, and then of course came Friday, where this large reversal bar stopped out there any remaining longs at 40.96. So of the three positions, we still probably made a plus 80, but it was a pretty ugly and fearful decline on Friday. Based on the 260, you can see that 2 of the 3 downside targets have already been met, as the selling was relentless throughout. After Powell spoke, there was just no let up. The daily chart here had turned to the short side here on the 22nd and on Monday, and had a little rally against the position, and but since it's done quite well, we hit the first downside target based on the daily, 40.73, and outstanding targets at 40.05 and 48.68. So as somebody asked me in a subscriber only session, well, how do you handle that when the market's that crazy? And I said, well, one way to judge it is to have a position based on the daily and on the 260 minute, and that way, if they're in a disagreement, you'll benefit, which would have been the case here. As I mentioned earlier, based on the S&P 500 advanced decline data, 97.8% of the stocks were lower. S&P 1500, that's the small cap 600, mid cap 400, and the large cap, 95.53% were on the downside, and the NASDAQ 100 around 96. This is typically a short-term selling complex, selling climax rather, and so it does suggest we should get an oversold bounce sometime next week, but we did also cut through some important support here. This daily chart of the Spider Trust shows you that we closed below this shelf of support here, dropped actually below the Stark bands on Friday. AD line here was looking pretty good as of Thursday's close. It popped back up above here. Has not, of course, we're watching this last low. If we drop below that, which seems pretty likely probably early in the week, but we don't try to second guess the indicators, that would create a new downtrend in the AD line, of course, which would be a sign we're in a corrective mode. This chart of the QQQ, you can see we're already retraced 38% of the rally with Friday's action, 50% level at 301. So it's about 6 points below where we are, and additional support down here. The key 61.8% retracement is at 294. So using Fibonacci analysis, we closed below that. It indicates that this whole rally is over. Looking at the cash S&P, you can see that we've just clipped the 38% support, 39.82, 50%, and 39.01, 61.8% there. Same rules would apply. Of course, we just tested the 200-day moving average. Didn't get above the 61.8% resistance on this last move up, and so that's what the level we really needed to overcome to confirm a further uptrend. Looking at some other measures of the advanced decline line, you can see that with the close there, we got right back down to the 100-day moving average, 405.50. We closed at 405.31, so a couple ticks below it. You can see here the 50-day and the pivot for August are in the 398.50 area, 389.69 for the pivot. So that's the most logical next downside target. So that's about 7 points below where we are on Friday. Other AD lines, different data source, has not also broken below those lows. NYSE stocks only is weaker, and as is the NYSE. So it's not going to take much of a sell-off on Monday to drop this below that moving average, or below that prior bottom. And if it does that on a closing basis, of course, as I mentioned before, it would be a sign of weakness. frankly, not a lot of good news on the short-term basis. This weekly chart, the S&P shows we hit this downtrend. Investors, based on the AAII survey, still not very bullish, down to 27%. They're typically used as a contrary indicator, but maybe they're getting better. I've looked at this data going back to 87, and usually, you want to be on the opposite side of the percent bullish. So we'll see. This is the exposure index. It peaked. I was looking for a move above 80. We didn't get it. Back down to 54.86. So next week's number should give you a better idea whether we're, buying the dip from the active money managers. Weekly, we're still above the breakout level and the moving average. Typically, a failing rally, we would drop below this moving average in the next week or so. So we'll be watching it closely. As I've been mentioning, there's been very little put buying lately. You can see that changed on Friday, 1.39 in the index put call ratio, so 1.1 in the total put call ratio. So a little more bearishness, and I would think you'd probably see some carryover bearishness on Monday's action as well. The NYSE advanced minus decline oscillator, and it looked like we dropped down to minus 1200. Usually a sign of a short-term low. That worked for Wednesday and Thursday. We got back up to plus 400 and closed now at minus 520. So still, if we get down below minus 1200, down in this range, as I said, based on the 90% down day, we'll probably get a bounce, but we'll have to watch it closely because it has to be pretty strong. Otherwise, it's a rally that should be likely sold. One last chart here, the number of QQQ or NASDAQ 100 stocks above their 10-day had a rally back to 22 on with Thursday's close. That looked like it was going to move back up in near to the 60 level. No dice, back down to 6. So, that doesn't mean stocks still can't move lower, but you can see that that's a pretty about as low as it gets, and is often a requirement for set. A quick review of the closing data from last week. So we closed at 40.43. The daily analysis negative from Monday, as I said, 822, 41.46, up 2.5%. Hit the first target here, 40.73, 40.05, then 39.68. The reversal price based on the Friday close is now at 42.43. So still above the entry. The 260 went negative at 40.96, and it hit it actually closed below the first target here. That's why we have this little caret in here. This often means that the market is already extended in the direction when you get that large a bar, but we have hit the second target at 40.86, third target at 40.78, with a stop right now at 41.97. That will drop probably in Monday's session. Well, so for the week, we got stopped out of a remaining short position at 41.37 for a total of 153 for the three positions. Long on Wednesday at 41.37.80. Hit the first target for about 50 points, second target for about 74 points, and then gave up 41 points on Friday's reversal of the downside, which is where we're short. So I hope you found this information beneficial. As always, if you have questions, you can always email me at tom@viperreport.com. Next week should definitely be interesting, so I'll keep in touch.